All right, so before we talk about PVH, I do want to mention a couple of upcoming logistical changes that I made to our syllabus. So I put up in the announcements. So today, we're going to focus on the solution for the PVH valuation, talking about the as is, the bull, the bear, and the target, what we needed to do by that. Next Wednesday, so I just moved it. It was originally scheduled for next Monday, but next Wednesday will be midterm 2. Okay? And so next Monday will be a lecture. All right, based on what happened in earlier sections today, didn't get through everything I wanted to cover with the PVH homework assignment, so I felt it'd be better to talk more about that before we did the midterm. So midterm 2, Wednesday, not Monday. That really shouldn't affect anybody because we're doing it during class time. All right, so it's similar to midterm 1. You'll take the class that you're registered for. The midterm will open 5 minutes before your section starts. It will close at the end of your section time. You have to complete the midterm during that time. All right, if you have an exception, see me for a code. You'll take the midterm exception, but basically the midterm will be next Wednesday. It's 5% of your semester grade. Here's how it's different than midterm 1. Midterm 1 was quantitative, basically solving a problem, the converted statements. Midterm 2 is going to be qualitative. It's basically going to be, do you understand the content that you're actually solving for this semester? Okay, so it's open book, open notes. You'll definitely need a computer. Again, no collaboration, honor codes, individual assignment. But basically, anything we talked about this semester is fair game. All right, I don't distinguish between what's in the book and the class. I assume you've read the book. If you have questions about it, you ask me. So essentially, anything in the book, anything we talked about in class, any of the lecture notes, any of the assignments, that's the content that's going to be on there. It will be a series of multiple choice and short answer questions. Okay, the multiple choice will always have none of the above as an answer, and the short answer questions are just going to be that. Okay, so again, I will tell you that I haven't created the exam yet, but generally the exam tends to lead more towards things we talk about during class. So key value drivers, 4 cornerstones, valuation issues, etc. Here's a good example. I brought this up in the last class. Might be a good question for this midterm. But what does it mean for a company to have a negative G in perpetuity? So that might be an example of a midterm 2 question. What does it mean to have a negative G in perpetuity? So how would you answer that?
Long-term growth rates, they're shrinking.
It's going to be shrinking. So what does that mean? What's the implication of that? Yeah.
You're going to be creating less value, and if it's it could be like decreasing at a decreasing rate, if that makes sense. So like over time, you're going to be creating less and less value.
Yes, that's actually the exact right answer. Okay. So, but here's the other question. So let's take it to the extreme. Company's G is negative 2%. Does that mean they're going out of business? So that's the thing. A lot of people make an assumption that a negative G means you're going out of business. And in some cases, it might be. I mean, like JCPenney's is in, they're in a death spiral. I don't know if they're going to be able to pull it up before they go out of business. All right. So that G might actually be negative enough that they really do go out of business. But generally, when a company peaks, all right, and it goes into a more mature decline stage, then you're going to have a negative G by definition. So it's what she said is actually very true. Like when you're in a growth mode, G is positive. When you're in a decline mode, which just means the future is worse than today, it's negative. Right? So even in perpetuity. So therefore, I just want you guys to understand that because that's going to be important context as well for the PVH conversation we're about to have. Right? But that's what I mean by a midterm type of a question. Right? I will also tell you 2 questions that will be guaranteed to be on the midterm. 1, here's an ROIC tree, analyze it. 2, here's a CFI, analyze it. Those will be 2 questions on the midterm exam. Okay? So essentially, I've already told you what probably 40% of the exam is going to be, right? But nonetheless, it will be Wednesday, November 6th. Okay? And then next week, group case 3, group project 3, will be due next Friday. Okay? So a week from this Friday. But obviously next week's the midterm. We'll have class next Wednesday. So you want to get started on it this week. Group case 3 will be available later today, and you're able to start it on today. Also, homework 9, which is an individual assignment, will be due a week from Monday, but I'm going to make it available today because of next week's midterm to give you a head start, because you'll all see the Bloomberg Lab to do these assignments. So this Wednesday, which is October 30th, there'll be no lecture. It's just a Bloomberg Lab day to work on the group case 3 and the homework 9. Monday in class lecture, so see you next Monday, we'll talk about finishing off the conversation today and prep for the midterm. Midterm next Wednesday, and then the following Monday we'll be back for a regular class. Okay, it's just some upcoming logistics I want to make sure we're really clear on. All right? So, questions about that? Great. So let's talk about PVH and the as-is model. So where we left off, go back to Excel here. Is you should have exported the data for PVH, overwrote the model data tab. You should have gone to assumptions, made sure the last reported year matched 2019, or fiscal 19. Then, based on your screenshots, should have taken a wax screenshot and used the 6.9%. Right? By the way, just because somebody asked about the last question, somebody asked what MR means. Period MR appears most recent. That's the WAC you want to use. Because they said they had actually used the annual WAC, which would have been back in February. And so you want to use the discount rate today. Because if we're valuing the price today, we need today's discount rate. So you don't want to use historical WACs when you do your valuation, unless you're valuing it everything at that time. Right? But since all the cash flows are from today forward, we need to use a current WAC. So 6.9 is the current WAC.
What if yours was different?
I'm sorry?
When I took a screenshot, mine was 6.8.
That's why we do screenshots.
Okay.
So the reason why we want you to upload screenshots, there's actually 2 reasons. So reason number 1 is exactly that. The date is going to change as you do these valuations. And so based on the price, you should be in sync with that, and that's okay.
Okay.
Right? So that's actually one of the reasons why we do screenshots. The other way is it's a good way to catch cheating. Because basically every screenshot, in case you haven't paid attention, has an individual serialized number and machine number and a timestamp on the machine. So if those ever match, it's bad for you. Okay, so don't turn in somebody else's screenshot. That being said, put in the 6.9%. Then you'd put in, I said 1% was the G. I wanted you to have in there. The share price, at the time, off the DES screen, mine was 90. Share count, 74.1 million. Okay. Then you'd have gone to EEO. You'd have put in the revenue for these 3 years and the EBITDA for these 3 years. And then you would have put in the 2 trading multiples at the time of your valuation. For the second forward year, 2021, EV to EBIT and EV to sales. So EV to revenue, 1.11, EV to EBIT, 11.65. Right? Then you've gone over to ratios. Now, what's important is that we have some Nike data in here. So what I like to do, I'm going to undo what I did here. You're just equaling the previous year. I like to equal the previous year for EBITDA, revenue, and tax rate. And I like to do that for the simple reason that, and carry it forward, so that if I had hard-coded some numbers in from, for example, Nike, and they're lingering around in my PVH model, it could do really weird things to my valuation. So things that I'd likely to change, I like to kind of put back to a baseline so I don't have some weird hard-coded data points, right? So those are the only ones that we'd have really changed for Nike. But this is where I got some emails. Because when we did this, basically Nike was fairly close to the current share price at the time we got to this stage. But PVH is actually pretty far away, right? And that's actually why I like PVH, right? Matter of fact, that's what I was telling the previous classes. Like, that's what I actually like about this class, is this class is messy, right? You know, when you take other classes with Harvard Business School case studies, basically they find an exact problem with an exact solution at a point in time to prove a point. But that's not the real world. In the real world, you get this, where sometimes it works really well, like Nike, and sometimes the academic stuff is really messy and you got to figure it out. So part of what we're going to have to do today is figure out what's actually happening in the marketplace. But continuing on with our process, we got to get these share prices within $1. The next thing we need to know is the tax rate. So back to Bloomberg, you've gone to EVT, and you would have done a search through the reports, and what you would have found in the annual conference call, which was this one. Actually, no. It's this one. It's this one. And you search for a tax rate. There was guidance on the tax rate. Spell correctly.
The analysts are saying this company cut guidance for the upcoming year and stuff. What does that mean?
Hold on. Tax rate 14.5 to 15.5. Okay, so that's where we would get the tax rate. You could have also, okay, better question second. You could have also looked at the BRC, the analyst reports. You're going to get somewhere around this range. Okay, so I'm going to put in 15%. It's my placeholder for a realistic tax rate going forward. But this is back to the point. I'm still pretty far off from my current share price, and I need to make sure I have my EBIT margin based on the multiples 9.5%. Let's come here to ratios. I need this to be 9.5 perpetuity. So this would be 12.9. That's weird. Guess there's a rounding error there. All right. I'm going to leave it there. Call it rounding. But the point is, when we do all this, I know it's not the margins problem. It's really going to be growth that has to be lower to get the share price. So that goes back to consensus. So some companies, not all, so go to PVH, give what's called guidance. So in the guidance, they're basically saying, here's a range of what we think we're going to do. And then on the quarterly calls, they will update that guidance. So it's just kind of giving general directions to the analyst because they want the analyst to be somewhat accurate, because I don't want the analyst to be far off from what I'm going to do. Bad in both directions. So they'll guide the analyst towards what they're going to do. Some companies don't do that at all because it gets dangerous, because anytime you put a number out there, there's a lawyer waiting to sue you, right? So that's the problem, because you're going to miss that number and somebody's going to say that you defrauded them, especially if they lose money. And the lawyers don't care. They just want money. So generally, companies give at best ranges, and sometimes companies don't give any guidance at all. But typically in a guidance cut, what they're doing is they're guiding down saying we think lower revenue and or lower earnings, typically. Okay? Good question. All right, so back to this. So what I really need to do is I need to understand, how do I get rid of some of this value to get a more realistic value of the as is? Now I'll just mention that I actually think PVH is a broken stock. Right, Kramer would call this a broken stock. Or Warren Buffett would also say the same thing. And here's what I mean, which is in the as-is model, which we are building, we're doing a DCF, and we're trying to get the DCF to match the current share price. And if we just kind of at this point, run the current situation forward, right? Basically, we're at a price that's a lot higher than the current share price today. So obviously, the market thinks that it's going to be worse. And we put in the earnings estimates, right? So if you really think about the earnings estimates, they don't seem too unreasonable, yet the share price is a lot lower. So if you remember, I said there's a buy side and there's a sell side. So we're putting in the numbers from the sell side, and the sell side is talking to the buy side. And generally, the buy side listens to the sell side. But I think what PVH is an example where you see a disconnect between the two, right? Is that I think the sell side is more optimistic on the company than the buy side. Because the buy side, the people that actually own the stock, are not paying $120 for PVH. They're paying $90. So they actually have more reservations about what's going to happen to this company and industry going forward. So if you just think about this, just, what are we seeing in the headlines? We're seeing stores closing left and right. We're talking about the retail apocalypse. Where do most of PVH's sales go through? Well, with their supply chain. Most of their sales are going through brick and mortar stores. And these are the people that are challenged. So even if PVH is doing well, the problem is the people that are actually they're selling through are not doing so well, and that could affect them. So the flip side is they can start selling online, but the problem with online is Amazon is not your premium branded store. Amazon's the race to the bottom, and so therefore it's about giving customers the best deal possible. So I'm not saying they don't sell more online, but unfortunately for them, it's not the high margin channel, right? And then all that expansion, we're in the middle of a trade war in Europe, so how much expansion, or with China I should say, how much expansion is going to happen in Asia in the middle of that trade war? So I just go back to the story that, I'm not saying it's right or wrong, but my sense is, and we're going to start to see this in the as is that the buy side is just skeptical about the company. So therefore, they're discounting what the analysts are saying, for better or for worse. And that's where I think you're seeing a disconnect between our valuation as it stands right now and the current price. But that's the point. We got to figure out what this price is going to be. Now, again, what's the valuation based on? So let's go back. Go to the valuation tab. Now we chose a 5-year DCF and then perpetuity starting in year 6. Relatively short year-by-year forecast. Implication. For this value, they don't have that much debt. So for the enterprise value, all of it is operating value. And the majority of it is year 6 in a perpetuity. So what happens in the first 5 years is not nearly as important as what happens in the continuing value period. So again, translation. I think the analysts, I think the institutions, the people who are buying the stock, are more worried about this than this. Because I cut the 2022 in half, that knocks out $300 million of DCF. That's not going to really affect the share price all that much, right? So if we think about it, and I got to cut 30% out of the share price to get my model to match, what I really am going to have to tweak is the continuing value, right? So PVH is a story about challenges with those continuing value assumptions. So let's go back to our KVD. What are those assumptions? Well, it's going to be G, it's going to be ROIC, and it's going to be WACC, basically spread growth, right? So I hinted at this, but I told you the G is probably closer to 1%. Okay? So I told you to put the 1% in to the G. And in just a few minutes, we're going to talk about how we actually estimate a G, but I was at least giving you a more realistic placeholder. Because I think what the market's assuming is less G, right? But the problem is, at 1% G, which is what we have in the model, we still have a positive spread into perpetuity and still have a value that's too high. So I'll say it a different way. I think what the market is saying is that even though the model suggests a positive spread to perpetuity, that they're being valued as if they have a negative spread. Right? Because if you think about it, what's going to drive that continuing value is growth and spread. So if we have positive growth and we want to have less continuing value, we have to have negative spread. Right? Because the other option is we have negative growth and a positive spread. And we would have to ask ourselves, which of those two is more reasonable? And based on what we know about PVH, do I think that they're going to be shrinking in the future? Or do I think they're going to be growing in the future? Right? And again, here's my also personal point of view on this. I think the real world has blinders past 2 years. People can't see past the current situation of whatever the company is. So right now we're in the middle of a retail apocalypse, so therefore everybody's in trouble, right? And we're in a trade war, so we're all screwed, we're all going to die, right? But the practical reality is, long term, China is going to be a booming market, as are the rest of the Asian countries. So is India one day, and very soon, Africa. And there's a lot of people there that are going to be buying clothes. And so PVH is a global brand. Calvin Klein underwear is being sold everywhere. I think it's going to do well long term. So if I kind of think about this more rationally, I don't think PVH is really going to struggle with growth very long term. So I don't see a negative G at this point. I don't think they've peaked on their growth. So what I think the market is more worried about in the current share price is not the negative G. I think they're worried about the negative spread. That's why instead of negative growth, high spread, I'm thinking positive G, negative spread. And so that's how we're going to get the model price to match. So how in the as is do I do that? Well, I have a couple options. Option one is I can start cutting the growth rate because that's going to be cash in. Okay. Option two is I can change the margin. And option three is I can change these balance sheet ratios. Because if I increase the balance sheet ratios, that also reduces cash flow because I'm investing more cash in the business, right? And therefore drops my ROI. Now, my personal preference is to leave the operating income margin alone. Now, I'm not saying that you can't change this. This is just general guidance. But the reason I'm less inclined to change this is because of this. Like the trading multiples say that has to be the margin. And people are actually paying that. So of those assumptions, I believe it's not the margin. People believe that there's going to be less growth in the intermediate term. Not the very long term, but the intermediate term, less growth. And I think more investment, therefore lower ROI. So here's what I'm going to do. I'm going to switch, I played with this in the earlier class, to the EPEOI 2025 was, problem is we have a 9.6%. Apple, I hope you're listening. Your next computers better have another keyboard or I'm switching. It's just awful. All right, in the EOI, problem is we have a 9.6% ROIC into perpetuity. And it's that which is driving the share price with the growth to 133. This was basically what people were emailing about. Like, how do I cut this? What do I do? So, as I said, we can either increase the balance sheet investment or we can cut the growth. Or, since this is based on the perpetuity, what we're really concerned with visually is this. And that's the key KVD, which means, as a shortcut, it's these assumptions. Okay? So here's the point. I could just say 5%. At a 5% ROIC, which is now a negative spread, notice how my share price drops. And then what I'd probably have to do is go to about negative 6% growth. Now, at this point, whether we're slightly higher ROIC and slightly less negative growth, or slightly more negative growth and slightly changing ROIC, somewhere in this range is what you would have needed to do your as is. And very clear, I don't agree with this. So my bias is probably going to lead towards a target recommendation that's going to be a buy. I actually think it's not going to be as bad as these numbers suspect, but nonetheless, it could be. I could be wrong. But I think that's what you're seeing. Is that right now you're seeing a takedown of PVH's value, and what the market has to be worried about is growth, margin, something which is not being priced into their stock. Now, as a third alternative, you could have made an argument that the buy side is not using the margin in perpetuity that the academic formulas say. But that one's harder because then you'd have to make up an even higher ROIC. So what I'm saying is, if it got the margin, the problem is the ROIC has to be lower, which suggests a lot more investment for less sales. So I think that is a way to interpret a better way to kind of price this stock. But nonetheless, that's going to get us to our as-is. Questions? All right. This is something new you're going to need to put in your models, which is going to be part of your next assignment. So I'm going to pivot here and talk about G. So you might say, why did I give you a 1% G? Okay. So this is material in the book we haven't gotten to, and the lecture note hasn't yet been posted. But it goes back to multiples. And one of the things that we're going to learn is that multiples are just the rearranged key value driver equation. This is the key value driver equation. Matter of fact, this is going to become the PE equation. This is how you calculate a PE. When you rearrange this to this, it becomes the enterprise value to EBIT multiple. You can rearrange it again to get the enterprise value to sales multiple. So what you're going to find is all the multiples are just the rearranged KVD. That's all they are. All right? And they absolutely have to sync up. So we're going to talk about the derivations and what they mean and how to analyze this in the next couple weeks. You're going to read about this, and you're going to do a lot of this. But as a preview for what's upcoming, this formula, which is in the book, is the KVD rearranged, which is the formula academically that gets you the enterprise value to EBIT multiple. Specifically, this formula should get you, in Bloomberg, EV to EBIT 2021, which today is 11.72. It should get you that number. Okay? So here's the deal. We know that number. We know the EV to EBIT today. It's an observable data point. We have a good estimate of what the tax rate's going to be. There's not a lot of disagreement in the world about what the future tax rate of PVH is going to be. We have a pretty good guess of that. We have a pretty good understanding of our WACC. Plus or minus a little bit, that's the WACC of the company. It's not different than the industry WACC, so I think it's a reasonable WACC. It leaves us with two final variables, G and ROIC. G is the hardest to calculate because it's a perpetuity ever compounded growth rate number. ROIC is more representative. I think that we have a more reasonable chance of estimating what the ROIC is based on our model. We have a sense of what their ROIC is in the past, and based on our model, we can relatively accurately forecast their ROIC for the next few years. So here's the point. We put in the ROIC. Solve for G. So the way that you are going to do on your next homework assignment and everyone thereafter is instead of arbitrarily putting in a G for your as is, you're going to back solve a G based on market data. And that's going to be your starting point for your G. So when you do your as is, let's go back. This is the process for your next homework assignment as well. And probably a great question for the midterm exam. So basically, you would leave these growth rates alone. So you basically get to these two numbers, G and change in growth rate. Those are the last two numbers to forecast when you do your as-is valuation. Okay? So you put in the WACC, you put in the share count, you put in the EBITDA margins, you put in the tax rate. You're just left with growth rate in the short term, and you're left with a G. Okay? Now this is iterative. It's a multiple variable equation. But here's the point. Take this equation and put it into the model. So we're going to solve for the enterprise value to EBIT in our model. Okay? And there are four inputs, which are already in our model scattered, but I'm just repeating them right here so that it's easy to see. So we're going to need a model G. So I'm just going to put a G right here, okay, which is different than the one that's actually driving the stock price. So I'm going to put in a model G right here. I'm going to put the tax rate, which is ratios M10. That's our final year tax rate in a perpetuity. Model WACC is the WACC up here. The CV ROIC is the continuing value ROIC that we're using, which I arbitrarily changed to 5% already for the long term, rather than changing the balance sheet. Given those four assumptions, which are in yellow, I need to solve for this equation. So let's do that. Equals left paren 1 minus the tax rate, right paren, times left paren 1 minus the growth, G, divided by the ROIC, right paren. Take all of that and divide by left paren, the WACC minus the G. So we have a keyboard that works, doesn't keep dying on you, divided by the WAC minus the G. So what it says is that those four assumptions come true. The multiple should be 11.62. The trading multiple as of the time of my evaluation was 11.65. So what I'm trying to do is get these to match. So for example, if I had put in 1% as a starting point, then I wouldn't match exactly. If I put in 3%, I would have a multiple. It's a keyboard of 8.72. That's why I knew when I gave you this assignment why I said about a 1% G. Because I knew if you put in a 3% G, you would never get the model to work. It would start doing crazy stuff. Because in order to get the trading multiple of PVH, this is what the G approximately had to be. I knew it had to be around 1%. That's why I gave you that assumption. So what I'm telling you is going forward, you're going to be able to do this yourself on your next assignment and all future assignments. So this is the final change you're making to your valuation, is to do an initial G estimate. Now recognize that this is going to be iterative, because when you put the G in the model, it's going to change the ROIC. And we change the ROIC, the G and the ROIC will iterate a little bit. Okay? So this is essentially avoiding a circular reference. So here's the point. Let's go to 1%. 0.9 is actually the number. So here's what I mean by that. 0.009. So I basically set this G, which is the one that's actually driving the stock price, to equal to that. Notice when I do that, share price is still not low enough. So, minus 6. So, here's what I know about the PVH as is situation. In the intermediate term, not the very long term, but in the intermediate term, the market's worried about growth. And they're discounting the stock accordingly. They believe that the analysts are too optimistic. And so in the real world, if you're a buy-side fund manager, there's two ways you can handle this. One is the blunt instrument, which is I just use a higher discount rate. Arbitrarily, I know the cost of capital is 7%, I'll just use 9. Okay? And it's not an ideal way of doing it, but some people just do it. Let's raise the cost of capital, automatically discounts the stock, lowers the trading multiple that you're willing to pay for stocks, and basically prices companies down. The better way to do this is to forecast cash flows. And I think that's the other thing that's happening, is that there was an article in Bloomberg last week, Bloomberg.com, that said that for the upcoming year, analysts on average have dropped consensus earnings estimates by 10% for the S&P 500. So we're going through earnings season right now, and because we're getting near the end of the year, analysts are projecting 2020 again, they're reprojecting, and as companies are reporting, what they're starting to do is they're projecting lower. They're basically saying earnings next year are going to be worse than originally expected. And so I think that's what's happening, is we're in the middle of this. I think people are more nervous about the analyst EEO numbers being too high. So therefore, I'm going to arbitrarily cut them myself. I'm not going to pay as much for the stock as if I followed those trading estimates into what PVH stock price should be, right? And that's why we're doing the as is. And this is what I mean by there's a disconnect between the share price and the DCF value. And it doesn't matter what my opinion is, right? In terms of the opinion of the ratios that explain that are what I have to do. It's not whether I agree with it, because that is the trading price today, and math is math. And we have to explain that math rationally. So when you write up your as is, this is what you have to write up, and your assumptions accordingly. Questions about anything I just did or anything that you were doing? Yes.
Did you just pull that growth rate equation, John?
Which one? I'll just put up the equation. Do you want this one or do you want the one in Excel?
In Excel.
Okay. So just getting this equation with the right order of operations into this cell with those fields. And again, what I'm trying to eventually match is pretty close to kind of like the as is, D16, and D19. Because what it says is this is the equation in the cell that you're entering is to basically match academically what the trading multiple should be with what the trading multiple is, and then using the assumptions, we're backing out an approximate G. Now, if this were your assignment, and instead of 0.9, you use like 0.92 or 0.887 or something like that, we're not going to quibble about that. What we are going to quibble is if you use 1.5, right? Because if you use a G that's not realistic in your valuation, it's not a correct answer. And for the as is, there is a correct answer, or at least a reasonable range of correct answers. Once you get to the target, the bull and the bear, you can change this G, right? Because if I get to my bull scenario and I think, look, the market's being too pessimistic about the growth for the reasons I just mentioned, and I actually think that the G should be higher, I can change it there. I can change in the bear, change in the target, change in the bull. But for the as is, I want you to back out from observed market data, right? And while you're doing this equation, this is the other thing. You work for an investment bank, you're doing an M&A deal, and or you're doing a company that's going IPO. This is the math you use to figure out what the trading multiple will be post-valuation, okay? Because you sync it up. You look at comps, look at deal comps, what companies are trading at, but then you look at the justification for those comps based on the forecasted cash flow multiples, and you sync them up. So this is actually a very important process that we're going to talk about a little bit later for triangulating our values. But nonetheless, process I want you to follow. So last thing in your as is you forecast the G and the growth rate. You might iterate a little, but probably what you're going to come up with is around 0.9% for your G and negative, if you did it this way, and negative 6% for your growth. But what you're really saying for the as is PVH is growth challenged in the middle term, intermediate term. And long term, the market believes for tepid growth, it's going to eventually have a negative spread. That's the way they're being priced today. All right, questions about the PVH as is, questions about the equation, questions about anything that I just talked about. Okay, because from here, we would do our bull and our bear. Now, as I would do the bear, save this, and then add on, I would say that I don't think the bear is going to be too much worse than this. Okay, so again, I'm going to start to illustrate my bias, but like I actually think if you think about bull and bear range, this current price is pretty near the bear price. Okay, because a lot of things have to go wrong with this company. They basically have to start shrinking. Their ROIC has to much worsen. Their margins don't improve. Now you can make the margins a little bit worse, but I think that will be the point. Like I don't think the growth is going to be much less. I think the margins are going to be less, and that would be the delta in the share price, right? So if I were to do my bear, so I'll save this, then now I would come in here and I might take my EBITDA margin, which is this number, which historically has been as low as 10%, back down to say 11%. And that gets me to a $71 share price. So if you think about what really could be the bear scenario, and to me that's the most realistic bear, is a collapse in margins. Because that is going to have a dramatic impact on the business going forward. And that's realistic, because if they're faced with currency pressure, if they're in the middle of a trade war with tariffs pushing on them, and they have to make up sales by subsidizing these tariffs, if they're looking at increased costs in their supply chain, because global supply chains are being completely disrupted by the realignment of global trade. And if the pricing is lower, because as I look around this room, and I've seen this in the previous two classes, with the exception of Under Armour, nobody's wearing polo logos like this old guy, right? You're not paying for branded apparel anymore. Your generation just doesn't pay as much, right? You're much more happy to just have clothes that look finally stylish to you, doesn't have to have a logo or not. That's what you pay for. That's bad for companies like PVH. It's Calvin Klein and Tommy Hilfiger want you to pay for that little logo. And unfortunately, companies like H&M and Zara and Forever 21 and others are driving people towards non-logo, low-cost, fast fashion apparel. And so if I play that out, put pricing pressure on them. Because you don't have the high-priced stuff that you did before that people are paying for in volume right now. So whatever the reason is, I would need to explain that and support that to why I believe the margins could get even lower. And that would be my assumptions. And that's what would support my bear scenario with a price of $71 a share. So I've established a bottom, which is even worse than today, but that would be the bottom. Say bull. What is my bull scenario? Well, I don't trade 6% a year. Stay with 1% growth, and my ROIC stays close to positive, where it was, and then you're back at 130. Okay? So I actually think that when we started to baseline the model, before we started plugging down the as is, probably closer to where the bull range is in the next 12 months. So I got 71 at the bottom end, I got 130 at the top end. Where are they? Right now they're at 90. So my target price, to be honest with you, I think it's closer to the 130. I haven't put the numbers in, but I probably put something closer to that, and I would call them a buy. I think they're worth over 100. Okay? Now again, you don't have to agree with that. This is where we can have some divergence, but that's what you should have done for your next 3 models. Questions about what you did do? Want to validate anything with the class? Because you're about to repeat this for VF Corp. No questions? All right, that's easy this week. So homework 9, which is due 1 week from Monday, is a repeat of homework 8, except the company's going to switch to VF Corp. Okay, so you're going to turn in 4 models, as is, bull, bear, and target. You're going to do a 500-word write-up. Okay, so explaining about 125 words, your assumptions. Very important. Explain your as-is assumptions as well. And this is what I mean by explaining your as-is. Explain why you're using the G that you're using. Explain why you're using the spread you're using. Explain why you're using the margins you're using. Okay? I need to know your rationale as you work through the models. So talk through all 4 of those. And the other key thing that's going to be different this time is you must, in all models going forward, estimate the G based on the real world multiples. And for your as-is, use that G estimate in your model. So as we said, process-wise, as you update this model for VF Corp, put in the VF Corp data, put in the WACC, put in the share count, put in the share price at the time of your valuation, put in the EEO data for sales and EBITDA, put in the trading multiples, estimate their tax rate going forward, put in their margin going forward. The last 2 items will be G and revenue growth, percentage change of revenue growth. Solve for the G, finish the model off with the revenue growth rate. You might have to iterate a little bit there, but basically that's going to be your process, right? So now we get much easier in figuring out, really, it takes a little bit of the guessing out of what these are going to be going forward, right? Because again, we're using what the market is actually pricing these companies for. And every now and then you're going to get weird data. If you can't explain the weird data, then your company becomes tough. So, secondary recommendation. Earlier in this class, all the teams except for one chose their semester evaluation project. It wouldn't hurt to find out if you have a PVH issue before you get too far down the path, right? Because, again, after about a week, I'm not letting you change the company. And if you get some really weird valuation going on, you're going to have to explain it, okay, rationally. So now's the time to evaluate that before you get too far in. I'm not saying it wouldn't be fun to do, but regardless, you got about a week to change your companies, otherwise they're locked in through the rest of the semester. Questions about anything? All right, so the last team that didn't choose, please see me and let me know your team before you leave. For the rest of you, as I said, Wednesday, you can start working on VF Corp, and you can start working on the group case 3. Very important for group case 3. It's a 4-page case. It's got 6 worksheets that you'll have to analyze. Fill out all of the worksheets and answer all of the questions on those worksheets. Okay, because basically that's going to be key to the grading. So it's not only submitting a proper math solution, but you have to answer all the questions that go along with that. Okay, that's going to be due a week from Friday. Right. So again, Wednesday, Bloomberg Lab Day. So you have time to start working on those. Next Monday, lecture to prepare for the midterm. Next Wednesday, midterm. Following Monday, VF Corp is due, and then we'll start on multiples. Okay. See see everybody next week.
Do you have class or don't have class next Monday?
We do have class next Monday. Lecture Monday. Just Wednesday, lab day. No lecture. You have class, just not a lecture. Next lecture Monday, a week from today.